Welcome back to the deep dive. So we're digging into a stack of sources you sent over, all centered on a headline that, on the surface might just sound like bureaucratic noise.
Mm-hmm.
It's a major ruling from the U.S. Commodity Futures Trading Commission, the CFTC. But here's the thing. If you really look beneath the hood, what we are actually witnessing is not just technical financial news.
No, not at all.
It feels much more like a historical turning point.
It absolutely has that kind of weight. Our mission today is to analyze this pretty shocking announcement, specifically the ruling that came down last Thursday. This is way more than just a regulatory tweak.
Right.
It's a foundational redefinition of what Bitcoin and Ethereum even are as assets.
So let's nail down the core event. The CFTC has approved the trading of spot Bitcoin and spot Ether products.
On its own registered futures exchanges, yeah.
And we hear the term spot trading thrown around all the time. But for anyone listening who needs to grasp the full significance, why is that one word spot the real game changer here?
That's the whole ballgame. Spot trading is the critical piece, because it means you are buying and receiving the underlying asset immediately.
The actual thing.
The actual thing. You're taking true, instantaneous ownership. Historically, the CFTC regulated futures, basically a promise to buy or sell later. But by approving the trading of the actual asset on these highly regulated, federally supervised exchanges, they're institutionalizing the entire marketplace.
And this leads right to the massive implication, the big reveal. This decision officially puts Bitcoin and Ethereum into the same category as what? Gold.
Oil.
Gold, oil, other essential commodities.
Yeah.
For years, the market has been paralyzed by this one question. Are these things securities like stocks, subject to the SEC?
Or are they commodity?
Or are they commodities? And the CFTC has now provided that clarity. They're commodities. This is what the financial press is calling the uncuffing of Bitcoin and Ethereum. It removes that constant threat of much more burdensome SEC regulation, that certainty, that finality. It changes everything. Okay, so let's unpack this. And I think we have to lean into the history here because the parallels in our source material are so strong, they're almost unbelievable. It feels like history isn't just rhyming.
No, it's like a repeat performance is being set up. To understand the magnitude of this, you really have to go back in time, back to the 1970s.
Let's set the scene for gold. Before the 70s, trading gold was complicated, right? It was this disconnected, kind of cumbersome thing.
Yeah, not a mainstream investment at all.
Not on the big U.S. exchanges. And then comes this historic decision to allow gold to be traded on regulated U.S. futures exchanges. And that wasn't just some administrative checkbox.
Precisely. That decision, you combine it with the end of the gold standard and it just opened the floodgates. Once you had that transparent legal framework in place, gold went from being this, fringe asset to a staple of global finance.
And the sources give us a number that is just breathtaking. The spot price of gold after this, it increased by 4,000%.
4,000%. It's a terrible number.
I mean, how does regulation unlock that kind of growth? Wasn't gold already valuable?
It was valuable, sure, but it lacked fiduciary access. Before regulation, a pension fund manager, a bank, they couldn't risk their clients' capital on an unregulated, opaque asset.
Too risky.
The moment gold got standardized and regulated by an authority like the CFTC, it became eligible for huge institutional allocation.
Right.
So that 4,000% jump wasn't just, retail excitement. It was trillions of dollars of compliant institutional capital finally entering the market.
So that context is crucial. This CFTC decision doesn't just make Bitcoin legal, it makes it fiduciary friendly.
That's a great way to put it. But, we have another powerful precedent that's less about the price itself and more about the mechanics of trading.
It's the oil story.
The oil story.
Right, the 1980s. This is a great lesson in liquidity. In '83, WTI crude oil futures launched. And when it started, the volume was tiny. Something like 3,000 contracts traded in the whole first month.
Minimal. It was almost like a pilot project, paper contracts, then liquidity. But once it hit that regulated framework, the growth was just explosive. Within a year, volume jumped to over 100,000 contracts a month by the late 80s. Over 2 million contracts a month.
And today it's often over 1 million a day.
A day. And the lesson there is professionalization. The regulated exchange standardized everything, which allowed automated trading and huge institutions to step in. The second the asset entered a regulated exchange, liquidity just exploded. And that brings us right to the present.
Okay, so this is why it's such a huge deal for today. Let's dive into reason number one you've laid out. the arrival of the institutional giants.
Right.
For the longest time, institutions, pension funds, big banks, hedge funds, they stayed away from crypto. And the barrier was simple: legal risk.
It was a compliance nightmare. But now CFTC oversight provides this shield of protection. It gives them the legitimacy they need. They demand standardized rules, strict surveillance against manipulation, and, most critically, requirements for safe asset custody.
We should spend a second on custody. Because for a pension fund managing billions, safe asset custody means more than just a secure wallet.
Oh, it's exponentially more complex. It means the asset has to be held by a regulated custodian, often a bank, with segregated customer assets, ironclad audit trails, things that guarantee safe, compliant storage.
Without that, the investment just can't happen.
It's a non-starter. And the evidence suggests they were just waiting for this signal.
Yeah, that survey from Coinbase and EY Parthenon from early 2024, it found that a staggering 86% of institutional investors they surveyed have either already invested or are planning to.
And that 86%, that's the real story. The capital was ready. It was just waiting for the referee to blow the whistle. They wanted regulated access, and now they have it. A pension fund can now allocate a small percentage to Bitcoin for retirees and treat it just like digital gold storage.
Okay, moving on to reason number 2, which you said is the direct parallel to the oil story: liquidity and stability.
Exactly. The goal here is to fundamentally change how price discovery happens. Putting BTC and ETH on regulated exchanges will attract a whole new class of professional market participants. We're talking major U.S. banks, high-frequency trading firms.
The HFT firms?
Yeah, and they thrive on regulated markets with minimal risk.
So when the order book gets thicker, what does that actually mean for an individual investor? How does that create stability?
Well, a thick order book means there are just vast pools of buy and sell orders ready to go at any time. The HFT firms provide near instantaneous liquidity, which shrinks the bid-ask spreads.
Does more efficient.
Incredibly efficient. And high liquidity is the only real antidote to that crazy volatility we always see in crypto. When some whale sells $100 million of Bitcoin, a deep professional order book just absorbs that pressure instantly. It prevents those massive panic-inducing price swings.
So it moves the market away from being so easily manipulated and more towards how, gold and oil futures operate. The structure itself forces professionalism.
Precisely. And that leads us right to the third reason, the repatriation of capital.
Right. For years, the U.S. has had this sort of financial brain drain. Because there weren't clear U.S. regulations, all this money and trading activity flowed overseas. U.S. traders had to go to international exchanges to find deep liquidity.
And that was a huge economic and security problem. Our sources show data from 2025 where one exchange, Binance, accounted for over 40% of global spot trading.
41.1% to be exact.
I mean, that's a gigantic concentration of capital, completely outside the protection of U.S. law. The U.S. wanted that activity back.
And the CFTC approval is the magnet to pull it back. It fills that legal void. Now, all that activity can return to U.S. platforms like Coinbase or Kraken, where investors get the full protection of U.S. law.
The benefit is jurisdictional security. You no longer have to risk trading on some unregulated exchange that could freeze your assets overnight. This legal certainty is like a beacon, drawing sophisticated capital back home.
Okay, we've established the history, the mechanism, and the 3 massive consequences. So let's bring this home for you, the listener. How should we be thinking about our portfolios now?
First, let's just ground ourselves in the numbers from the source material. At the time of the announcement, Bitcoin was around $89,470.
And Ethereum was at $3,046.
Right. So the market is clearly anticipating this. But this regulatory shift really requires changing your whole investment thesis.
Okay, so takeaway number 1. Change your mindset. You're saying stop seeing this as a lottery ticket.
Exactly. Stop the short-term speculation. This is now being recognized by the world's biggest financial players as a legitimate store of value. It's a long-term wealth accumulation asset. Institutions are planning for 5-10-year horizons. Individuals need to adopt that same patience.
And takeaway 2, stay calm, basically. Prepare for, what do you call it, regulatory patience.
Yeah, we talked about that 4,000% growth in gold, but that was a journey over decades. The infrastructure, the institutional onboarding, it all takes time.
So there's still going to be volatility.
Oh, absolutely. Short-term volatility will persist. But you have to focus on the structural long-term floor that's just been put in place. Don't panic when prices drop 10 or 20%.
And takeaway 3, this is a moment to reevaluate your risk profile. Because a huge structural risk, The risk of the U.S. just shutting it down has now been largely mitigated.
That's the key. The jurisdictional dark corner is now lit up. The risk shifts from, will this be outlawed, to how well will this perform against other commodities? It allows you to reevaluate your allocation.
And finally, takeaway 4. You have to embrace this new professionalism.
You do. With the big institutions involved relying on rumors or social media hype, that's an obsolete strategy now. The market is becoming driven by sophisticated algorithms and global macro events.
So you have to do the work.
You have to do the work. You have to read, study, and really understand what you hold. Knowing the difference between a security and a commodity is no longer academic. It's foundational to protecting your investment.
Wow. This deep dive has really laid out how a seemingly dull regulatory document is actually a powerful accelerant for a whole new financial paradigm.
It's the moment history repeats itself. It's the transformation of crypto from a fringe, high-risk asset into a legitimate, globally recognized and protected commodity class, all backed by the full weight of U.S. financial law.
So as you think about everything we've covered today, here is a final provocative question for you to consider. We know that when gold gained clear regulatory access and standardization in the 1970s, it subsequently grew by 4,000%. Now that Bitcoin and Ethereum are officially on that same footing, what specific structural change from the entry of those high-frequency trading firms to the new requirements for safe custody do you believe will be the most significant single driver in replicating the sheer magnitude of that 4,000% historical growth precedent?